The fund that gives you stock market level returns with lower risk. It has no star fund manager at all. Instead, it follows a rule book rather than following gut feeling. You must have seen a movie with a very weak plot, but it goes on to become a blockbuster because the lead actor is a superstar. That is called alpha in stock picking language. It is the X factor that pulls the crowd in. Now, most investors either go passive, that is index funds, and accept average returns, or they go for active funds, chasing hot fund managers, hoping that they will deliver. But there is a way to mix both of these at low cost, rule-based funds that only picks the top performing and stable stocks. That's what today's fund video is about. It's based on a strategy that's been quietly beating the Nifty over the last 5 years, 10 years, and with less volatility. Imagine picking a team where every player is not just a superstar or alpha, but they are also injury proof, which is low volatility. That is what this fund does. It is blending performance with safety. Take a look at this index. It beats Nifty 100 across all time frames of 1 year, 3 year, 5 year, and 10 years. And it has done that with lower volatility or lower risk. Now, let me walk you through this scatter plot. This is where the real story can be told visually. On this chart, each dot represents a stock. Along the x-axis, we are measuring risk. It starts with low risk on the left and moves to high risk on the right. On the y-axis, we are measuring returns. The higher up you go, the better the return. So, the best case scenario is the top left, high returns, low risk. And the worst, that is at the bottom right, low returns, high risk. Now, look at the top half of this chart. These are the stocks that are delivering high returns. The alpha strategy hunts in this zone. It picks the stocks, the top performers, the stars from this region. But notice they are scattered all over the risk range. And yes, alpha gets you high returns, but it also takes in stocks with high risk. Now shift to the left side of the chart. This is where stocks with low risk or low volatility are. Low vol strategy resides here. It selects stocks that don't swing widely from here. They don't shoot to be the best performing stocks, but they don't give you a heart attack either. You will see some decent returns and some modest ones, but all with controlled risk. Risk is the key. Now here is the interesting part. What if you didn't have to choose between alpha or low vol? The fund we are talking about today does something smart. It takes 50% approach. 50% of the portfolio does a alpha picking and 50% goes for low volatility picks. The result is a multi-factor portfolio that captures the upside potential while it cushions the downside risk. So if you're enjoying this content so far, please consider liking this video. It helps me stay motivated and do more research. So this fund is like pairing a sprinter with a marathon runner. You get speed when it matters and you get endurance when it counts. So this is not about picking winners or timing the market alone. It's about building a process where two proven strategies work together. Alpha brings the ambition, low vol brings the discipline. The mix a smarter, more balanced way to invest in equities using index funds. The Nifty Alpha Low Volatility 30 Index Fund. This is a multi-factor fund that will have 50% alpha strategy and 50% low vol. So these scatter plot dots, they represent stocks across two dimensions of risk and return. The fund selects stocks that exhibit high performance, at the same time have lower volatility. Alpha is nothing but performance better than the market. So these are the stocks that tend to run when markets rise. Basically momentum stocks, your star performers. Low volatility is stocks that don't panic in a crash. They are calm, less drama, lower, sharper falls. And in a bear market, they quietly protect your wealth. By combining the alpha for growth and low volatility for protection, you get something like returns like a mid-cap or a momentum fund, volatility like that of a large cap index fund. So does this actually work? Let's look at 10-year data. Returns Nifty 100 is 12.7, mid-cap 50 gave 18%. This fund returned 17% and it has done with very low volatility of 14.9 compared to 16 and 21 of the mid-cap. Risk-adjusted returns or the Sharpe ratio, over the past 10 years, this index has shown better returns with lower risk compared to Nifty 100 or mid-cap 50. So it is not about just running faster, it is about not falling when others trip. Remember the story of tortoise and the hare. The hare zooms ahead, gets overconfident, it takes a nap. Tortoise is slow, steady, consistent, and it wins. Turns out that is also a great investing metaphor. Everyone is chasing high return, high risk funds, mid caps, small caps, momentum, basically the hares. But what if you could build wealth by being a tortoise without falling behind? That's Nifty Alpha Low Volatility Index. It is a tortoise that wins the race. This is not hype, this is math. This is the rise of smart beta investing where rules replace gut. Of course, no strategy works forever, but here is the twist. When markets crash, low vol shines. When they rally, the alpha takes over. So this combo can adapt to both the brains of an active fund manager at the cost of an index fund with rules, not human biases. That's what factor investing is. And this new fund is built on not one but two powerful factors, alpha and low volatility. Here is the biggest insight, a behavioral advantage. You and I are not machines. We will panic during crashes. We will sell when things fall. That is why we don't get full returns even from great funds. But an index that falls less, that hurts less. So you stay invested longer, and that means you get more for the long-term compounding. In short, a smoother ride is a longer ride, which is more wealth. Emotionally, this is a smart fund that you can own. So who's this for? If you want to have higher returns than Nifty or Sensex, but you hate the anxiety of mid-cap, small-cap volatility, you like passive investing, but you want better than the average, and if you want to invest smartly without chasing the next hot thing, in a way, this fund is a peaceful warrior. It fights for returns quietly, strategically, not by being flashy, but by being balanced. If Nifty 50 is old-fashioned or old school legend, then this is the thinking investors Nifty fund. Let's talk about something that goes beyond charts and strategies. The three real edge that investors have to outperform the market, because it is not just about what you invest in, but how and why. There was a time when having just access to better information gave you an edge. If you knew something before the market did, you were ahead. That was your edge. But in today's world, everyone has a Bloomberg terminal in their pocket. News breaks in seconds. Corporate filings, quarterly results, expert opinion are accessible to smallest investors. So the information edge is mostly gone. The next layer is the quant edge, being able to process massive amounts of data, faster, smarter than others. That includes building models, running backtests, using machine learnings, and also crunching numbers that human brain can't handle. And sure, there are still some funds that dominate this with this edge. But here's the thing, with AIs, APIs, platforms, these tools are widely available. Even retail investors can now run analytics that once actually required a quant desk. So this edge is leveling out fast, which brings us to the only edge that is still truly durable, the behavioral edge. This is about making better decisions, especially when markets are irrational. It means not panicking when others are. It means not getting greedy when the crowd is euphoric. It means recognizing when the market has overreacted and taking advantage of that, or spotting underreaction and getting in early. But most importantly, it means managing your own emotion, because no AI can stop us from panic selling. No model can hold your hands through a crash, and no spreadsheet can fix FOMO. That is why even the smartest strategy can underperform in the wrong hands. And a simple, well-balanced approach like the multi-factor strategy we saw earlier can shine if the investor sticks to it with discipline. The one thing that still separates a successful investor from the rest is how they behave when it matters the most. That's your true competitive advantage. So, if you want to win, not just on paper but in practice, you build a process that will help you stay invested, stay rational, and stay ahead. Because at the end of the day, it's not the market that you need to beat, it is often just you, your own mind. If you like this content, please do let me know in the comment section and also like this video. Consider subscribing to this channel for more such insightful lessons.